Welcome back, my friends. Is Blackstone in trouble? Blackstone blocked investor withdrawals from $71 billion right in February. The past year has been hard for Blackstone. Rising interest rates, weakening real estate values, fluctuating currency, and concerns about a potential recession have sent the stock sinking. Blackstone stock had fallen 36% during the past year, and these pressures aren't likely to subside anytime soon. So, what does this mean for Blackstone? What does this mean for private equity? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities, and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. Blackstone said on Wednesday it had blocked investors from cashing out their investments at its $71 billion real estate income trust, BREIT, as the private equity firm continues to grapple with a flurry of redemption requests. BREIT said it fulfilled redemption requests of $1.4 billion in February, which represents only 35% of the approximately $3.9 billion in total withdrawal requests for the month, the firm said in a letter to investors. The total BREIT redemption requests in February were 26% lower than the approximately $5.3 billion reached in January, the firm said. While gross redemptions for February are consistent with prior management commentary, the overarching data continue to align with our view around decelerating retail-oriented product organic growth broadly, Credit Suisse analysts, led by Bill Katz, said in a note to investors. Credit Suisse downgraded its rating of Blackstone's stock to underperform in November, partly because of the rise in investor redemptions from BREIT. Blackstone's shares were down 0.25% at $90.57 per share in afternoon trading on Wednesday. The stock lost 43% of its value last year. Blackstone has been exercising its right to block investors' withdrawals since November last year after requests hit a preset 5% net asset value of BREIT, which is marketed to mostly high net worth individuals. Blackstone expects to continue dealing with investor redemptions because some BREIT investors are making larger withdrawal requests in anticipation of a reduction in its size, its president Jonathan Gray told an earnings call last month. But the firm expects to work through the backlog of unfulfilled requests over time, he added. BREIT generated returns of 8.4% in 2022 compared with a 26% decline to the publicly traded Dow Jones U.S. Select Right Total Return Index. Blackstone is weighing options for Dutch merchant bank NIBC, including a possible sale, people familiar with the matter told Reuters. The fund manager has been informally sounding out other banks and potential financial buyers to gauge their appetite, said the People, who declined to be named discussing private matters. Deliberations are preliminary and may not lead to any transaction, the People cautioned. Blackstone has also been considering potential acquisitions in the absence of a sale, one person added. With its roots dating back to the 1940s, NIBC returned to the stock market in 2018 after more than a decade of private equity ownership under J.C. Flowers and Company. Blackstone took the bank private again in early 2021 for roughly €1 billion, a fraction of its book value, after negotiating down the price it originally agreed with the company over concerns about the COVID-19 pandemic. Valuations for listed European banks have risen since, buoyed by higher interest rates. But a recent crisis of confidence in credit institutions has set back the strategic plans of some mid-sized lenders, including Apollo Global Management-backed OLB in Germany. The Hague-based NIBC offers financing for industries such as automotive, commercial real estate, infrastructure and shipping, as well as retail mortgages. It has been exiting non-core businesses, including deal advisory and leveraged finance, in a bid to streamline its operations. The group had €22.8 billion of assets on its balance sheet at the end of last year and an equity value of around €2 billion, $2.21 billion, according to its 2022 annual accounts, which showed a profit of €179 million excluding non-recurring expenses. Mortgages made up the bulk of its loan book. Blackstone is weighing options for Spanish gambling company Sursa, including an initial public offering, IPO, people familiar with the matter told Reuters. The U.S. buyout group recently invited proposals from investment banks to manage a possible share sale and refinancing of Sursa's debt, said the People, speaking on condition of anonymity. It is common for banks managing an IPO to also provide a loan to the company. An IPO would follow a public share sale by Italian peer Lottomatica, backed by Apollo Global Management, whose shares began trading in Milan on Wednesday. However, Lottomatica's lackluster performance on its debut may impact the timing of a deal, the People said. Lottomatica, which pressed ahead with its listing plans despite recent market turmoil, priced its IPO at the bottom of its targeted valuation range and its shares have fallen in the aftermarket. Explorations for Sursa are preliminary and may not lead to a transaction, the People said. Sursa, a casino operator, posted €552.5 million, $609.24 million, in earnings before interest, tax, depreciation and amortization, EBITDA, for 2022. It had close to €2.3 billion of net debt in 2022, or 4 times its EBITDA, based on its latest annual accounts. Based on Lottomatica's valuation, Sursa could be worth several billions of euros, including debt. Blackstone acquired Sursa in 2018 at an enterprise value of €2.2 billion, according to Refinitiv. It was reported in 2021 by the local media to be exploring an IPO of the group, but a deal never materialized. The Blackstone and Starwood real estate investment funds are what are known as REITs. For those of you not familiar, a REIT is an investment fund that invests in real estate. REIT is an acronym for Real Estate Investment Trust. It could be structured as a mutual fund, almost like a stock mutual fund. Or, it could be set up as an exchange-traded fund, or ETF. If it is an ETF, then shares in the fund are traded whenever the stock market is open. That means that any investor could sell out whenever the stock market is open. Investors in the fund are furious. That is because many of them are now trying to get their money out of the REIT. Real estate values have fallen across the nation. And macroeconomic factors are weakening overall. So, many investors have current needs for cash and need to liquefy some of their assets. Blackstone and Starwood Capital Group are drawing attention from the Securities and Exchange Commission. The focus is their recent moves to limit the ability of individual investors to take their money out of the company's real estate investment trusts, according to reports that are surfacing. The real estate funds have recently seen a surge in withdrawal requests, amid a broad drop in investor sentiment and potential economic downturn. This led both private equity giants to pause redemptions after monthly and quarterly withdrawal limits were reached. Investors in and outside of the funds took notice, as has, apparently, the SEC. The regulatory agency reached out to both Blackstone and Starwood this month to assess the market impact and specific circumstances of the pauses, according to Bloomberg, which cited multiple anonymous sources. The agency was looking into how the firms served redemptions to their clients, and if any affiliates of the two companies sold their shares before the clients, according to one of the sources. The inquiries are not indications that either firm is under investigation or committed any wrongdoing, the report said. Representatives for Blackstone and the SEC declined to comment to Insider. A spokesperson for Starwood did not return requests for comment on Friday. Individual investors deal a blow to Blackstone's stock. Blackstone launched the Blackstone Real Estate Income Trust in 2017. Blackstone's fund is called BREIT, which stands for Blackstone Real Estate Investment Trust. The fund is designed to cater to rich individuals. And these rich investors are always looking for better investments. High net worth investors were looking for better returns in what was then a near zero interest rate world. Assets flowed into the fund and it was a success, at least for a few years. The Blackstone REIT amassed $68 billion in assets. The real estate market in the United States has reversed course. And investor sentiment is turning bearish, to say the least. Shares in Blackstone shares are down 21% in the past month. That compares to a 3% decline in the benchmark S&P 500 index. But most REITs invest in commercial real estate. Blackstone has taken heat over the past week for limiting withdrawals from the $69 billion private right. President and Chief Operating Officer John Gray defended the positioning and structure. Gray noted that investors knew BREIT had limits on redemptions. And real estate is not a highly liquid investment. And, in this case, investors in the fund want to take out more money than Blackstone can make. As you might imagine, in a degrading real estate market, publicly traded REITs have gotten slammed this year. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Just as a comparison, the $35 billion Vanguard Real Estate ETF has plummeted 26% year to date. Well, despite that so-called confidence, investors in the fund sent double the normal amount of redemption requests in November. New subscriptions in the fund experienced a major drop-off. Subscriptions fell to less than $500 million. That compares to $880 million in September. If you follow this channel, you already know that real estate prices are falling across the United States. Institutional investors snapped up properties during a stimulus-fueled frenzy. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.